Welcome back. Today, we're digging into something that most investors honestly just don't think about enough. But it could be the biggest factor in your long-term wealth. Forget picking the next hot stock for a minute. We're talking about the structure of your investments and how it's quietly deciding how much tax you pay. So, let me ask you this. Are you positive you're keeping every dollar of your investment returns that you should be? What if there was a kind of silent tax, a hidden fee that was just nibbling away at your portfolio day in and day out, and you didn't even know it was happening? And look, we're not talking about a few bucks here. The analysis from Hudson Financial Partners crunched the numbers and found this could cost you over $150,000 in just 10 years. Think about that. On $1 million portfolio, that much money can just vanish. Not because of bad stocks, but because of a bad setup. That's a huge amount to just leave on the table. Well, this invisible villain actually has a name. Tax drag. It's the perfect way to describe it, right? It's this force that just slows everything down. It's the money you lose to taxes, to fees, to these weird distributions you didn't ask for. And it all comes down to having an inefficient investment structure. This really brings us to the most important idea of this whole explainer. And the source material says it perfectly. It's not what your investment earns that matters, it's what you actually keep. You know, a 10% return sounds awesome, but if tax drag is secretly eating 2 or 3% of that, your reality is a lot less exciting. It's all about what ends up in your pocket. So where does this tax drag like to hide? Well, the first big battleground we need to look at is the classic choice. Do you put your money in managed funds, or do you buy shares directly yourself? This is where a lot of the action happens. At first glance, it seems like a pretty straightforward trade-off. You know, managed funds are easy. They give you instant diversification. That's great. But the price you pay for that simplicity is giving up control. And as you're about to see, giving up that control can have a massive, massive impact on your tax bill. Okay, now the data here tells a really interesting story. So you've got two investors. They both get the same 10% return before tax. But just look at that bottom line. The person with direct shares gets to keep over 10.7% after tax. The managed fund investor, only 9.3%. So what gives? Well, think about it. In a managed fund, when other people sell their units, the fund manager has to sell shares to pay them out. That triggers a capital gains tax event for everybody in the fund, including you. It's a tax bill you had absolutely no control over. That gap between the two returns, that's pure tax leakage. All right, now for the second huge decision. It's not just about what you own, it's about where you keep it. The source calls this the location decision. Basically, are you investing inside a tax-friendly retirement account? In Australia, we call this superannuation. Or are you investing in your own personal name?
And wow, this table just shows how different these two locations are. It's night and day. Inside a retirement account like Super, your earnings get taxed at 15% tops. Outside, that can shoot all the way up to almost 50%. But here's the real game changer. Once you retire and start taking an income, what's called the pension phase, the tax rate inside Super drops to 0. Yep, 0% tax on your investment earnings and your capital gains. It's just an incredibly powerful place to grow your wealth.
Okay, so with all these choices, how in the world do you pick the right path? It's not that one is always better than the other. It's really about what's right for your specific goals. And luckily, the source material gives us a pretty clear framework for making that call. According to the authors, owning shares directly really starts to make sense when you've got a decent-sized portfolio, say over $200,000. It's for people who really value having control over those tax events. That control means you or your advisor can be clever, like choosing to sell an asset in a year when your income is low to pay less tax. But that definitely doesn't mean managed funds are a bad idea. Not at all. They still make a ton of sense, especially if you're just starting out with a smaller amount. Or maybe you just want something you can set and forget. In that case, you're making a conscious choice to trade a bit of that tax efficiency for simplicity. And that's perfectly fine. Now, let's get back to that location choice. For those really big long-term goals like retirement, superannuation is just so hard to beat. The tax efficiency is just on another level. The whole system is literally designed for retirement planning, and it kind of forces you to be disciplined by locking that money away until you really need it. But on the other hand, what if you need that money before you retire? That's where investing personally, in your own name, is the clear winner. It's all about flexibility. You can access your money whenever you want. You have total control. And you can use parts of the tax system to your advantage, like franking credits, which are basically just the government giving you back the tax a company already paid. So, let's bring this all together. What is the one big takeaway from all of this? It's the simple, measurable, and honestly incredible power you get just by setting up your investment structure in the right way. The research suggests that most people could add an extra 1 to 2% to their returns every single year. And not by picking riskier stocks or trying to time the market. No, this is purely by changing how and where they invest. It's about being smarter and more efficient with the money you already have. And the key to unlocking that extra return? Well, as the team at Hudson Financial Partners points out, it really comes down to modeling. It means taking the time to run the numbers for your own life, comparing the different scenarios, and finding the structure that gives you the absolute best after-tax return.
Which really just leaves us with one final, and I think pretty important question to think about. Now that you know about tax drag and you see the power of getting the structure right, what is your current setup really costing you in returns that you'll just never get to see?